Okay, so I'll probably start here. I'll kind of start with the big picture, right? So today I'm going to be reviewing the underwriting of our fund. Okay, so it's through Cathedral Capital Group Fund. Talking a little bit about fund structure, I've kind of had this pretty cool. I don't know, not many people know about this, but I'm working through Avestor, is the company that actually set up my fund through. So we actually have this. It's called like a parent fund, Bighorn Capital Group. So this is like my parent fund, right? And now I can make these. Some people call them SPVs, or these different other offerings for my investors, to where, again, my limited partners can all come in through the parent fund up on the top, and then up here, and then this down below I have Cathedral Group Capital Fund, which I'm going to be talking about the underwriting of that one today. But also we're going to have other like debt offerings. For example, we were talking about private money lending and being able to borrow when we're doing a fix and flip at 8, 10, 12, whatever the percentage is. We're also going to be able to do that within that fund. So happy to answer any questions on that at the end too. But I mainly just wanted to kind of give you guys a highlight of it, and then kind of dive into the numbers. That way, if anybody down the road is interested in becoming a limited partner, or if they're just interested in see how deals are underwritten, they can kind of reference this and come back. And feel free to at the end ask questions, or if you do watch this video and have questions, definitely please reach out to me. But I'll kind of give you the big picture, right? The way we structured ours, and then I'll go dive into the underwriting. But the way we set it up is it's up to a 10% pref, and the way you could work yourself up to a 10 pref is I have A, B, and C class shares. So the lowest is the C class, so that would be if you have 30,000 or more is the minimum here. If you have over 100,000 invested, you're a 8% pref on the B class, and then if you're 250,000 minimum, you get the 9 pref. But how you get to 10 is for our first 2 million we raise, we have this early investment incentive to where we're going to step it up by 1%. So any one of these, if you're part of the first 2 million, you'll bump up 1%. So really the best way, if somebody is truly interested in this and wants to really create the best situation for themselves as a limited partner, would be to either A, come up with 250 themselves, or the other option is you can go and you can get some other partners and you guys can come in as your own LLC or your own, call it a fund of funds. But it really doesn't have to be complicated. It could just be you guys bringing in 250,000 together, and then you could get the 10% preferred. But the way my waterfall works after that is after the 10% preferred, then you go into the second tier, which is from 10 to 20% returned, and that will be an 80-20 split. So 80% to the LP, 20% to the GP. And then after we get over 20%, we'll be splitting 60-40 with 60% to the LPs and 40% to the GP. So I'll kind of get to the very end, but at the end we're projecting a 23.7% IRR, and that's over a 5-year hold based on the projection, and that's a 2.76 multiple. So again, I'm going to kind of dive into where these numbers come from, and then I've got some stuff on our fund strategy and lots of other stuff to share with you guys. But any questions before we dive into the underwriting? All right, let's get started. So I'll first off kind of explain this asset. So underwriting this fund based on this, we'll call it kind of our cornerstone asset, which is this Peterson portfolio. This was a portfolio of properties that we're buying as one transaction. We're actually buying them under seller finance terms. So it's very favorable terms. It's like a 3% interest rate, which I'll show you guys later. A collection of all these different. So this is the lot. I wanted to show you guys a quick picture of like all the lots that we're getting. And then I'll dive into the rents and all that first. But just to give you an idea of the asset, I also went in here. So this is in Laramie, Wyoming, where this is, again, where my first property I bought 14 years ago was here. Honestly, this has always been our kind of home base for our portfolio. Our office is here. Our office is actually just right down here downtown. And this is downtown Laramie. So the University of Wyoming is all right here. And this asset is located right here. This is the interstate running through Laramie. And then this is the highway that goes to Fort Collins. So anyway, the thing about Laramie is, to make this all relative, they always say in Laramie you can get anywhere in 5 minutes. So literally, you're 5 minutes from campus from here in the driving. So still, nothing's too far away. And there's also a lot over here in West Laramie. This is another part of Laramie that's kind of grown. But I think as far as, I wouldn't call it commuting time, but as far as time in the car, it's even closer to, and then right here is downtown. So it's just really close to downtown, good location. So anyway, that is the asset out there. A little bit more about it. It would definitely be a lower, more, we'll call it affordable housing project, just based on the rents that we're going to get. But again, in Laramie, I can just tell you from years and years of investing in Laramie, there's never been enough supply for the rentals in Laramie, and that continues to be a challenge. And that's really caused a lot of rents to increase, and especially at the top end of rents. But at the low end, you really can't find 1 bedrooms under $1,000. You can't find 2 bedrooms really under $800. And you'll see some of these are actually, well, yeah, I'll dive into all the different properties, or call it structures. So I kind of made notes. These are all the different addresses, and this is the bedroom bath counts. I kind of made notes of, like, these ones are actually stick built. So that's a stick built. This is a stick built. So I think at the end of the day, I've got 6 or 7 stick-built houses and then several mobile homes. But obviously, we own the land and everything that comes with it. So this is the current rent rolls. The reason why this is such a good buy is they're way under rented. Some of them need some love. Some of them definitely need some love, and just a lot of overall cleanup of the asset. But where I see the value is in what I put as our market. This is market values, and this is how I ran our base case. I mean, we're only charging $600 a month for a 2-bedroom, 1-bath trailer, which you just can't find anywhere in Laramie. So this will definitely be, we're not going to be making this a Taj Mahal or over fixing these, but keeping them basic and livable will be kind of our goal on this one. And this is kind of the stretch goal. So again, just looking at the trailers, there's a bunch of different trailers. Our base is 600. Our kind of stretch goal, or our high scenario, is 800. So as we work down through here, you can also see the stick-built ones are going to be higher, and we're going to put a little bit more money into those because obviously those assets will hold their value better than the trailers will. So anyway, I don't have to probably dive into every single one of these units, but I've broken down every single structure, where they're currently at and where they're going to be at. The last thing is this Quonset hut, which is a funny story we could save for another day, but this is actually how we found the deal. Was we were looking to rent this Quonset hut to keep we have a carpet cleaning truck, and we needed a place to store it, and initially we were just renting this humongous Quonset hut. It's like it's bigger than the size of a football field inside of it. It's just massive. And we were renting the whole thing for $500 a month, and we actually built a structure to keep it insulated. But this is a whole nother value add play that we have, and this is how we found the asset, and then we ended up putting this deal together. But anyway, there's a lot of upside value. I've just put $1,500 a month here. I mean, honestly, it's a lot higher. There's a lot more upside here. And again, there's just a lot of, let me just show you this too. So on this asset, if you're looking at it, I believe the Quonset hut sits somewhere like around here. And then there's another huge field here that's just open. So could be expansion for more multifamily, or honestly, based on this area, might be a good opportunity for another mobile home park. A lot of land, good zoning. Yeah, just a really good asset. So that's kind of the underwriting of gross income we expect. And again, I wanted to keep it simple and have a simple base case. Again, there's a ton of other opportunities on this property, or on this collection of properties, but I didn't want to make it too complicated in talking about all these other different ways that we could improve the land. But I just wanted to simply say, hey, what are the current structures? What is market rent? And what is the higher market rent? And that way I make this very conservative. And again, there's plenty of more upside that we could dive into, but I wanted to just keep it basic for now for the initial underwriting. Okay, so now I'll kind of go in. So this all feeds into so this is actually, I just realized this was one of my old underwriting. So this would be our Laramie. Here we go. All right, so here's our income. So this is literally just pulling that total top line income from here. So the total, this is the current, this is market, and this is the high. So I just basically pulled in the incomes. I pulled in utilities. I pulled in taxes from the tax records. The utilities are an estimate, but we have a lot of properties in Laramie, so we feel pretty good about that estimate and what utilities cost. Insurance is, again, we get it from our insurance provider, and we get quotes on that, so we feel good about those numbers. These are the numbers that obviously are variable, and there's no way of knowing it until we get into it, but I try to conservatively put in 10. Basically what I did is 10%, this is just simply 10% of the gross rents would go out to expenses per month. I put in 10% for property management, and then 5% for vacancy. Again, some people might say this is low, but in Laramie, well, I'll be honest with you, in our portfolio, we actually track this. We track, and this is across the state, but Laramie is even higher than anywhere. But we typically get 98% or higher vacancy, or like occupancy. I think 5% is a good accurate number. So kind of that all feeds into the NOI, which is kind of captured here again from the current, the base, and the high. Now we'll kind of talk about the acquisition and the financing, which is pretty exciting. Honestly, probably maybe the most exciting part about this deal. So the purchase price I got here, I've got improvements here, another $100,000 in improvements. Again, this is going to clean up the lot. This is going to clean up some of those stick-built houses, clean up some of those trailers. A lot of different things we're going to be spending on these improvements. So that puts the total project at $1.2 million. The loan amount is $900,000. So let me kind of go into the different parts of the loan amount. So anyway, the mortgage payment is, this is 75%. Okay, hold on. Yeah, sorry, this would be the leverage on This is basically just looking at 75% of the total value. This is not the actual current loan, so I'll keep moving. So here's the mortgage payment. This is what we're paying per month, and I've negotiated it because this is a seller finance deal. The current owner owns this free and clear, and he's financing it to us over 10 years, fully amortized over 10 years. So in 10 years, it's completely paid off. The rate is 3% on that, and the payment is $6,000 a month. So literally, yeah, the whole thing's going to be paid off. I mean, it's a pretty aggressive amortization schedule versus like a 30-year, but we're going to pay down principal fast. And it's, again, the fact that it's 3% is just, it's a game changer. So the amount of equity we would be bringing in on this deal would be $500,000. So this would be limited partners equity. I'll probably have a chunk in this of mine, and then obviously some limited partners involved in it too. Let's see. Here's where I'm going to come back to this exit price in a second. But for now, here is the mortgage payment annually. Again, I'm just taking 12 times this. So basically, this is the NOI, which I pulled from up here. And this is the fund management fee, which we're charging 2% for us to manage it. And this would be the cash. Okay, so this would be basically the NOI. This would be the cash flow, basically, for the property. So again, in the base case, it's not working. But this is not the base case. Need to be clear on that. This is what it was currently bringing in before we came in. Once we get it to the base case, it's about $40,000. And if we get to the high case, it's about $58,000. So this cash on cash is 8%, conservatively, more like 12% as we hit the high case. So that just shows you the cash flow, just purely based on the current assets that are there and making the improvements we talked about. I did want to talk about exit price because that is important too. I used a conservative 8% cap rate, and this is just calculating a cap rate calculation. So I'm taking the NOI, the net operating income, divided by the 8% cap rate, and that's how we're coming up with this value. And same thing here, we're just using an 8%. I mean, if we go look at what really truly cap rates are, I've seen them around 5 to 6 in this town. I mean, if we look at 6, that significantly changes this whole thing. But I wanted to be conservative on a cap rate and use 8%. Yeah, so now let me get into the waterfalls and kind of how we've set this up. So we talked about kind of the distributions earlier about the pref and all that different stuff. So what we do is I actually bring it down here into this this kind of table. So I calculate the yearly cash flow in year 1, year 2, year 3, year 4, and year 5. But the other big thing is obviously in year 5, that's when we realize this big chunk, which this chunk is simply accounting for all the amortization. Because again, we're going to pay this off in 10 years. I should have started this. Well, this was probably obvious. This is over a 5-year hold. After 5 years, we're planning to sell the asset based on this pro forma. So if we sell it in 5 years, at that point, we pay down a significant amount on the loan. We're also at that point realizing this actual value up here of the NOI, the exit value that I talked about up here, exit price. So literally that's just factoring in all the cash that's going to come at the back end. So then the simple IRR calculation is pretty easy. It's just IRR of $500,000 comes in from the limited partners. We distribute this much cash flow over all the different years, and then the last year, that's when we do the significant one. So if you run all that in, that's how you come up with the waterfalls and the equity splits, with the IRR. So then when we go plug in all these different, and I could go into these other, this is a whole nother sheet that I'll probably save for today, but happy to dive into it. All this sheet does is it calculates our waterfalls. So it simply takes in the $500,000 I was talking about, and then the yearly cash flow that comes in, and it talks about, okay, first 10% goes to, you can ignore the 8%, but basically the first 10% is going to as a preferred return to the LPs. Then the next 20% is split 80-20, and then the last split is 40-60 after 20%. So anyway, we don't have to dive into all that, but if somebody wants to, I'm happy to. But anyway, that basically is where we come up with this, and we throw out this multiple of 21.26, a cash multiple of 252. So if we kind of go back into our underwriting, that's where we're coming up with this, and as for our projections, right? So again, this is for people who aren't familiar with IRR, this is a simple IRR calculation. It's the best way to compare apples to apples. Think about it this way, right? So if you want to compare, hey, what if I put my money in the stock market or put it in something else? Like, what does that growth look like? Because again, you get cash flow every year. Moving back to here, you're getting this cash flow each year that the company is throwing off, right? But then we hit this big influx of cash at the end. So the way to account for that to look at it annualized, if you looked at over 5 years, it would mean you made 21.26 annually as a return. So that's the best way for people who like to look at cash on cash return and kind of compare apples to apples. The second piece is the multiple. So that's just looking at, hey, if I put in 100,000, then I would end up with 252,000 after 5 years. So you literally 2.5x your capital that you put in over 5 years. So I'm going to pause there. I got my high case here too, which I didn't talk about a whole lot. Again, the only difference here is the increased rents, because again, taxes, utilities. Some of these things go up, right? Because this is based off of the percentage of the rents. So you will notice that, expenses go up, property management, some of that, vacancy, that calculation goes up. So that's really the only thing that's changing. But utilities, taxes, all that stuff is going to stay the same. Obviously, your mortgage payment doesn't change as you increase the income. So that's why you start to see in the high case we're hitting a 3 multiple and a 26.2% return. So that is a highlight of all of the underwriting. So I'm going to pause for questions here, and then I can go deeper.
In case you're not sure where you're headed next, but you have a 5% vacancy, and that obviously affects your pro forma on the revenue side. Can you speak a little bit about other properties there in Laramie like this one, if there are any, and kind of the management process that you're going to be able to bring to the table to make sure that we hit those numbers for occupancy?
You bet. Yeah, good point on the occupancy. So I kind of touched it a little bit earlier on, just like across Laramie, the occupancy across the city is super high, right? Vacancy very, very low, unless you just have a property that's like unrentable. But even some of those are renting. But the other thing I haven't mentioned yet on this one is, again, just the price point. There's really nothing you can find and even with the trailers or 2-bedroom, 1 bath. When we go back into this pro forma, you're really not finding any other properties this cheap in town. So that's where I think that the vacancy will be very, very low. That's why the property management fee, I put it 10%, because there will be more headaches, if you will, that the property management team will be dealing with just based on this tenant base. But again, one of our plans is to actually set up these, which James will like. We're planning to set up the trailers as lease to own. That way they take on the repairs. So if we get that done, these projections get even better because like the expenses will be zero and they'll be managing, and then just every part of it, the management's less and everything. But kind of answer Clint's question, the fact that we are going to be the cheapest thing on the market, and there's nothing really like this. There's no other. I mean, there are some other trailer house. There are other mobile home courts in Laramie, but again, there's a limited supply of those. But nothing that's kind of like this, that's kind of sprawled out and has room to grow. To where, again, there's so much land. I can't show you can't kind of see it here, but if we kind of showed you the aerial view, there's just a lot of development and opportunities to go add more of these trailers on there, and like I said, expand a trailer park. So, and I think that helps us with vacancy, which Clint was asking about, but the second piece is just the value, right? You're not going to be able to find, it's hard enough to find multifamily properties in Laramie. When I was talking about cap rate, and I mentioned seeing a lot of the deals are trading and selling at like a 5 to a 6 cap rate, just because that's what people are paying, and people like Laramie, and they like the appreciation, and they like the low vacancy, and so I think this could be even lower just based on the lack of supply and the lack of properties in Laramie like this. Because honestly, Laramie's going to have to start building at some point, but it's very. That's, I guess, another big component of Laramie that maybe a lot of people probably don't know like we do, but it has a limited amount of contractors. It's just really hard. We've actually brought contractors in-house, which is another component to this that helps us ensure that we can get the work done. But not a whole lot of builders, are in Laramie and expanding in Laramie, and everyone hopes that's going to change, but it's been like that forever, and for whatever reason, there's a big shortage of new construction. And that's probably one of the biggest drivers of the fact that there's still a lot of demand from the university and jobs and companies that want to be employing people in Laramie, but there's just a lack of housing. Good question, though, Clint.
Nice. So obviously you're going to dive deeper, but maybe you can circle back to some of those plans on how to do value add and force appreciation with adding units. That'd be really cool.
Yeah, you bet. As far as some of the different upsides, I'll keep coming back to this kind of map. We can even look at this one too, and maybe I could zoom in and get you guys. Let me go back here. Let's try going this. Well, actually, that might be better. So this is, let's see, I go lot lines. Okay, cool. So you could kind of drive down the road. I'm going from memory, but let's see, where's our Quonset hut? There's our Quonset hut. That's the easy thing to identify. So this is, you guys can see how massive this thing is. And this is that huge area for development that's all owned within this asset that's not being utilized. So I think there's a ton of options. So let's say that we're able to go in and seller finance these trailers, which would be great because again, it'll just increase our cash flow. We could continue to go in and bring in new trailers and actually build that out. It's got this. We've looked into the septic and other different, and looked into the utilities about the viability to do that, and it looks really good. So anyway, a ton of different options there. Even building, or maybe this area 5 years from now, it makes sense to go build apartments in this area just based on the lack of. We talked about the lack of contractors and the lack of supply on the market. So that's one option. Another thing which I haven't talked about or touched on at all, which I'm glad kind of Clinton, you prompted me to think about this, is so when we go back to the fund, I've underwrote this fund based on this asset, right? But we're going to continue to add other similar assets. As probably many of you may know, we have a direct to seller company that finds these off market deals. So that's how we found this deal, was off market. We negotiated it, got it done. We're going to be doing the renovations, and then we're going to be managing it. So that same model, we will continue to look at other properties in Laramie and other markets we're in. So this will be across Wyoming and Montana are the plans for now, just based on that's like where we really have a strong foothold and have, again, we have already doing marketing in those areas. We have contractors like in-house in all three or throughout Wyoming and Montana, or at least southern Montana at this point. And then we could do property management in-house. So we will continue to find other deals that pencil similar to this. But what I wanted to do was give limited partners, hey, this is the first asset we will be taking in. That way they can kind of know, hey, what can I expect? What's an actual tangible asset that we're buying? But we will continue to add, because I haven't talked about, well, I did talk about at the beginning about the first 2 million is going to get the bump up of 1%. But this is just a $500,000 to do this. We'll obviously be buying other assets. And I have other assets teed up for this. For example, I have a new construction one in Sheridan, Wyoming that has opportunity to put multifamily. It's in a great area of Sheridan. So it's like basically like an infill lot to where we can add other multifamilies on that property. And then we just have a constant lead flow of deals that we could be putting in here. So we can add more buy and holds. The other beauty is we could go do a fix and flip on something. And again, anytime you do a fix and flip, you're not going to see the monthly cash flow, but say it's a 3 or 4 month project. After 3 or 4 months, you get a nice little chunk of cash, right, from the flip. And I'm kind of diving deep here, but the other really cool thing about this fund is the way it's set up. And not many people I get this luxury because I'm an active real estate investor, and I have flips that make income, and then I have rental properties that go and depreciate and actually offset that flip income. So for the limited partners to get into this, they're going to be able to, because all this, like all the accounting, everything funnels up through the parent fund, and that fund will be issuing the K1s to the limited partners. So if you think about that, all those limited partners are going to get the depreciation from like an asset like this or any other buy and holds. They're going to get depreciation and write-offs, which again is phantom depreciation. The asset is ultimately appreciating, but we can write it off. So that will actually help us to offset, say we did a handful of flips that brought in a bunch of more like short-term, to where that typically would be a short-term capital gain. Well, we can actually offset some of that income through depreciation on these buy and holds. So it's a really cool strategy to where we could give people, and then again, I don't know, I can't speak to everyone's different tax situation, so you got to talk to a CPA on all this, talk to a CPA, but there might be opportunities where if you have other gains from, there's a very real chance based on how we depreciate and if we do cost segregations and have other write-offs from this fund, that you might be able to carry over passive, or let's see, those would be passive losses and maybe offset other passive income you have in other assets. Again, don't quote me on that. Definitely talk to your CPA, but I know that there is, in some situations, there's ability to that, to where if you're tracking with me, you would literally be writing off, you'd be able to take a deduction and write off income from other investments. Even though this one's making money for you, it's technically going to be shown as a loss. But let's give that caveat though. At the very end of the fund, and when we sell all these assets, you will realize all that depreciation. But again, that's when it'll be really fun to get into that with our limited partners. We're like, okay, we're about to exit. We're going to have a lot of income coming in. Well, what if we 1031 exchange all this? Or there's a lot of other different creative ways that we can structure things to where we can continue to. That's, the beauty of being a real estate investor is you're able to write off your income and keep kicking that can down the road. And yeah, that's a discussion for another day with 1031 exchanges and trusts and all that. But anyway, I really wanted to highlight that part of the fund, that because these are buy and hold assets, you have a huge benefit of depreciation. What other questions you guys have?
Casey, one question. You mentioned there's a college in that town. Are you seeing any cycle in and cycle out when school goes out of session and back into session?
Yeah, James, good question. I used to think that, right? When I invested for probably the first 5 years, I kind of had that. Yeah, I always had that. I don't know. It was almost that myth in my head that yeah, when the summer comes down, all the students move out of town. Well, the beauty of Laramie is well, okay. Well, first off, let's start here. My way to mitigate that to this day, and it always has been, we sign 1 year leases with everybody, and it's just standard. Like no landlords, not many landlords offer month to month, and it's just if you're going to get into a property, it's just accepted in this market. If I'm going to get a lease, I got to sign up for a year, and a lot of those students will either just eat that for a couple months if they move, or they'll stay, or they'll sublease. So that's the way we've always mitigated. But as Laramie's evolved over the years, though, it's pretty cool because Laramie has turned into like Laramie in the summertime is one of the best climates in the country. It's really nice every day. It's like it never gets above like 80, 85 degrees typically. It's just like 70 to 80 degrees. It's like San Diego, California in the summertime. But anyway, you're up on the high and everybody loves the outdoors. Like that's the best time of year to be in Laramie. So anyway, it's starting to get more like yeah, just a lot more tourism that's happening in the summer. And it's always been up there, but ever since COVID, it's definitely increased. So anyway, it kind of washes out in the market, right? Because you have a ton of demand from say September when school starts to May, and then from June and July and August. Now you're in the summer times, and so we don't have to worry about it because they sign 1 year leases. But even if we do, there still is a lot of demand and people coming in and out of Laramie. What other questions you guys have?
Question about when you're going to be rolling this out, and then you mentioned when we get to the end of this, you're going to sell these assets. Will that be something where you sell it and you're now owner financing that? So the tax liability would be maybe this is a longer term investment and that's an installment sale moving down through the path, or will this be an actual cash out? Have you thought that through?
Yeah, a lot of different scenarios, which again is kind of the beauty of this. So yeah, the current underwriting is it for in 5 years we would go to sell it at that point, but that won't always make the most sense because yeah, there'll be a taxable event at that point. So there's a lot of different options, right? We might just go to our limited partners and say, hey, after 5 years, are there people who want to exit? Because if you're going to exit, you're going to take a tax. There's going to be a tax implication, right? Or we just keep it going because again, I'll have this thing paid off completely, fully and clear in 10 years. So you could just continue to keep it. Another option is we just refinance it. I just go, for anybody who wants to cash out in 5 years, we go get the portfolio appraised, and that's the number we go off of, and ultimately we would go and refinance that either through a bank or through other private money lenders or just through within my, kind of from my portfolio. But there'd be, multiple exits after 5 years, and that's the thing too. I want people to never reach out. Like the benefit of this fund is staying in long term, but I want to make sure people feel like if you're just concerned about, hey, what happens to me? What if I have some sort of event in 1 or 2 or 3 years? Like, let's talk about that because at the end of the day, if somebody was like, hey, I need to get out of this, I'd probably either pick up those shares or another investor could come in and take over those shares. But yeah, I got to be careful because you got to read the PPM to kind of understand all that. But at the end of the day, it's very flexible, right? And the other option is we could sell one of the properties, right? Let's say a bigger partner was interested in getting out, we would have the ability to approve basically selling one of those assets, cashing them out. But again, the better situation, as anybody who's ever been a buy and hold real estate investor, is just to keep holding it because the asset will keep growing. We can always go refinance and get some of our cash out if we need, and then just keep that asset. James, I'm sure knows this, but everybody else who's listening, the beauty of a cash out refinance is if you do that, you pull out your cash, you could pay back the limited partner's money. And at that point, that's not a taxable event to do a cash out refi, right? But if you sell it, it's a taxable event. If you cash out refi, it's technically, because it's still a loan, you can actually kind of get the best of both worlds.
Last question I have, since this depreciation is going to be needed by some parties and not by others, could we decide how much of that we do or don't want to claim to reduce our liability when we do cash out? Let's say I need none of that depreciation. Could I gift that or sell that to a different partner?
Yep, that is a really good question, which we'd have to definitely talk to the CPA on. But yeah, that's a good one, James. I'd have to go back and check on that one as far as, because everybody's depreciation and situation should be a little bit different. At the end of the day, you're going to get a K1, so there might be optionality to where you can, I also know sometimes with depreciation, you can kick it down the road. You could decide, sometimes you can carry it over to future years. But definitely a good one, but not one I could quite answer.
I think James may have asked, but it sounded like when you were going to roll this out.
Yes. Oh, yeah, that was the last piece. Yeah, so we are actually right now we're taking. I think. Oh shoot, I've got an email too that I could share with you guys and share with anybody else. When you're watching this video, you may have already seen it, but we're currently taking soft commitments, and then this asset is going to actually be acquired here in the very next couple weeks. We're actually just finishing the title work on it, and then we'll be getting it going. So we're able to actually take in capital right now. Right now, over the next probably 1 to 2 weeks, it'll just be soft commitments, and then then we'll actually start being able to accept money. The hope is in March. So yeah, we're sitting here middle of February, or February 23rd today. So in March, be able to actually transfer the money and actually to where you start making a return on the capital.
Casey, you kind of alluded to this being an ongoing thing where you're going to add other properties to this at some point, exit on this. Is this a long-term vehicle, or is this something just temporarily to take this portfolio down and then ease out of it?
Yeah, really good question, James. It's definitely a long-term one. So this is again just kind of like our cornerstone asset that we'll take in it. But yeah, we've been looking at this fund for years because of ultimately our ability to find deals, fix them up, and keep them as long-term rentals. And that long-term strategy, that's how I built my portfolio up. And the idea here is like, let's go build another portfolio. But we wanted to kind of put the 5-year constraint on it as far as underwriting. Again, we've got flexibility. I don't think anybody is going to want to go sell in 5 years if we're in a bad point in the market. But the beauty is this is a buy and hold investment, so you would just hold on to it a little bit longer. But absolutely, we'll be buying this asset along with other similar type assets. And when I say that similar types, it's more so similar type cash flows and properties that our fund and our company has been kind of our bread and butter over the years, which could be single families, could be flips, could be small multifamily, and even large multifamily. But again, it's going to be focused on single family and residential real estate will be the focus.
Thank you.
You bet. Clint, any other questions you can think of?
Mine are just more technical on the back end side for investors when they expect K1s and distributions, things like that, if that's in play here.
Yeah. No, I'm glad. It's definitely a good question. So when it comes to K1s, that is the beauty of, I'm going to go back to my kind of structure here. Think about this Bighorn Capital Group as the parent fund. The beauty is, and this is just our first offering, right? This is the offering of Cathedral Group Capital Fund. We will also have other offerings where like you could just be a lender, and in our debt fund that goes and lends on our fix and flips or does other type, or maybe it lends to other fix and flippers. And then maybe we go find another multifamily property that we want to adjust that doesn't quite fit into this bucket of the Cathedral Group that I'm talking about, but maybe it's a big syndication. The beauty is all those will be wrapped into this Bighorn Capital Fund. And you as a limited partner can come in, and the coolest thing, and this is where it's a long way of answering your question, but if you want to be a part of the fund, you will invest at the parent level, right? At the top level at Bighorn Capital Group. Your money comes in there. At that point, you could decide, hey, I want to put $50K in Cathedral Capital Group. I want to put $50K in the debt one, and I want to put $50K in this one in a year from now in this big multifamily property we're buying. You can allocate your money however you want, but the beauty is all that money gets funneled up into 1K1 in the parent company. So at the end of the year, you're just going to get 1K1, and you can have exposure to multiple different types of assets, which is really cool. The other neat thing is you're going to have a login to this portal, and you're going to be able to go look at all the different offerings and all the deals, and that way when you start, or if at some point you want to go invest more money, you'll always have access to that portal to go in, and you'll be able to see all the accounting and see everything you need as far as information on that side, but you'll also be able to see the new opportunities. But at the end of the year, yeah, you'll be getting K1s from here. Oh, we did not talk about distributions. We'll be distributing quarterly on these funds, and yeah, that's kind of the nuts and bolts. But this was a big reason why we looked at a lot of different fund structures and talked to a lot of different people in different masterminds, and we landed on this one because we really like the interface that it has with the investor, to where you guys can, again, you'll have your own login, which is probably another video for another day to show you guys how all that works. But you'll be able to have really cool visuals into how the fund's doing, what you're investing in, what your K1s look like, what do distributions look like, and all that.
Thank you, Casey. Are you going to provide us a copy of this recording? I've got other people who are going to want to see this as well.
Absolutely. Please do. Yeah, please share with anybody you guys know. And again, so the intent here is this recording will be shared. That way when people are like, hey, I want to understand the underwriting, dive deeper, they can go into here. And then I still encourage those people, if they want to still ask more questions, I'm always available for that. But the thought is this is kind of one piece of sort of maybe someone's due diligence, if you'll call it. They'll have this. We have our one pager. I'll just really quickly show these while I got them pulled up. I think I got a couple other ones here. Maybe not here. But anyway, I've got a couple other different documents that I can also share that I'll go over You know what? Let me just pull it up here. Might be able to pull it up. Maybe not. We'll share it another time. But anyway, yeah, we've got one that like kind of dives into a case study. We've got a bunch of different case studies of, okay, let me break this up. So the first one is a project book that goes over like all of our single family, the stuff fix and flips we've done. We've got another larger case study. Actually, probably going to have two of them. One of them is a 14 unit we did in Laramie, where it was a value add where we bought 14 units and we bought it, brought up the rents. We like doubled the rents in like 12 months, which was pretty crazy. But again, we just know the Laramie market and we knew this asset was under rented. So we've got that case study. We've also got the case study we're in the middle of, which is our 63 unit apartment complex in Casper, Wyoming. We'll also be kind of providing the one pager showing, because that one we're kind of like maybe about halfway through the cycle on that one. So we're happy to provide all those. I've got a one pager on like the Wyoming market. I've talked a lot today about supply and demand, but it kind of talks about Wyoming and Montana as a whole. And then the last one is just the last kind of two are like it's a background of myself and then a background of our company and talks about, hey, how we go direct to seller, how do we fix and flip and run construction, and then how do we do property management. So you'll have all those different resources as like kind of one pagers to share with people.
Wonderful. Thank you, Casey.
You bet, James. Well, we knocked it out in an hour.
Yes,
Any
sir.
other questions?
Cool. I don't unless...
Awesome. All right. Well, I'll stop the recording. Appreciate you guys. Again, let me know if you have any questions, please. And how you guys could reach out, best way is email Casey@GregersenProperties.com. Just make sure you spell my last name right, Gregersen Properties.com. But I'm sure we'll have plenty of links and you should be getting some communication from us.
Thank you
All
again.
right, thank you, guys.